Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your weekly technical analysis of the Chicago soybean complex.
Chicago soybeans. For a few weeks now, I've highlighted the longer term charts and explicitly the 5-year moving average, currently 1192. This ultra long term moving average plus the 2021 low at 1181 were the reasons for the mid-May to mid-June hesitation and eventual turnaround back up, which brought beans back again into the teens. The two key individual pieces of action for the move up happened 6 weeks ago, with a pair of opening long white Mariposa's. The second one actually punched up through some key resistances consisting of the combination of the base of the late 2022 descending triangle plus the lesser Fibonacci line, both at 1378. These turned from being resistances into supports. Now, that did not mean they were not tested once again, as only 4 weeks ago we saw the market test lower. But the next moving average below, that's the flatlining short medium moving average, currently at 1365, held up the market and prices punched back up again, with what turned out to be a weekly key reversal up in late June. The move up also punched through and closed over two key resistances: the declining medium moving average, currently at 1406, and the flatlining long moving average, currently 1441. The latter had been effective as a cap on the market throughout June and caused the pipe top just after the middle of the month. Now, the separation of these two moving averages after they had formed a dead cross only a few weeks prior, back at the start of June, no doubt assisted in the market's break up through them, as their individual powers could not match the sum of when their powers were combined. This then led to the hesitation we saw in July at the 50% Fibonacci line of the big December 2020 to February 2022 move at 1451. Just beyond that, there was also another big 50% Fibonacci line, this time from the February 2022 to May 2023 move at 1476. Between these two, and I suppose the long moving average that sometimes acted as a base, the market was slowed in its rise. Now, the market did punch up through the 50% Fibonacci lines, but had a real problem stabilizing over the one at 1476, such that when changeover came, we ended up with a gap down, the lower end being back around the medium moving average. There has since been a recovery, filling in the changeover gap and even opening a smaller gap between 1432 to 1435 formed over this past weekend on the way up. This now leads us to what the recent late June to date action could be, or should I say could be seen to be. Last week I spoke about an idea which I will review and discuss a couple of new ideas for the recent action as well. So last week I spoke about, and I quote, "If you look back late March and into April here, you'll see we made a double top with the highs being based on the 1500 area. Well, the recent action bears a strong similarity to that action, and so the question is this: do we have a similar double top now?" End of quote. Well, the answer to this is yes. We do have another similar double top formed over the first half of July. Okay, so over to the new ideas, and they were twofold. First one is to look at the late June to date action as a possible ascending triangle, currently at 1425 to 1491. This has some merit, though still it is not a very good looking pattern. We are still within the ascending triangle, so no targets as yet. However, I can lay out some potential sizes for the move should they happen before my next commentary. Thus, the primary move topside for such a pattern would be 108 cents on top of the confirmed break, with a secondary harder to reach move of 154 cents on top. A primary move downside for such a pattern would be 68 cents off the confirmed break, with a secondary harder to reach move of 154 cents off the confirmed break. The second idea is to look at the whole mid-March to date action as a possible, very large reverse head and shoulders pattern. Now, it's still too early on this one to verify such a pattern, but it is worth considering. Though the one key point against it is the location of this pattern. It does not look too close to a bottom, as the November 2021 and the 2021 low indeed are lower. However, I would keep this idea at the back of your mind just in case. Chicago soybean meal. The biggest pattern here had been the May 22 to date, broken, then repaired, then broken again, and now the desperately repaired again, ascending, expanding wedge pattern. It's a huge pattern that I pointed out many months ago. It was never a perfect pattern by any means, but it finally started working in late May this year. To assist you in seeing this pattern, I've highlighted it on my daily chart in dark blue. However, the upper trend line is slowly exiting top left, though the lower trend line, currently at 428.5, is still here. There's also the neckline of the huge December 2021 to June 2022 head and shoulders continuation pattern extension. The break lower this past May, below the trend line and neckline combination, indicated a potential primary target that is still well off the bottom of my daily chart at the incredible 324 zone area, and a secondary much harder to reach target in the 283 zone. These are ones you can make a note in your diary and maybe look at once or twice a year. However, the resurgence back up in mid-June from the double bottom pattern, as an Adam and Eve type, this has postponed any potential big picture targets below for the moment and instead concentrate vision on the top side. Thus, from the double bottom, the market had punched up and closed over the following: the 50% Fibonacci line, the October 2021 to March 23 move at 403.60. The short medium moving average currently 410 even. The declining medium moving average currently 428.30. The lesser Fibonacci line at 425.90. There's the neckline, of course. The combined congestion made up from the early April 2021 high and highs from January and February 2021, all at 433.5. The ever so slowly rising long moving average, currently 436.90. And finally the April 2021 high at 439.30. We are now in a relatively open area overhead, all the way up to just shy of the 2021 high at 471.40. However, the hesitation we saw throughout late June and July, which looked for a long while like a possible topping action, has given way to another pattern, one I highlighted last week, and I quote, "Please bear one thing in mind, though I haven't drawn it as yet. The action since mid or even late June has a strong possibility of being an ascending triangle, such that I would watch carefully any moves lower just in case." End of quote. This week I have formalized this pattern, which is highlighted in bright red on my daily chart. And that's currently 426.30 to 436.90. Yesterday the market broke higher out of this pattern and today has exploited that move even higher. Hence it is time I gave some potential targets for such a pattern. So for a break higher from an ascending triangle, we'd have a primary target in the 458.5 area with a harder secondary target in the 471.5 area. Interestingly, the latter is coincident with the next significant resistance overhead, and that's the 2021 high. This brings me once again to my final point, which I raised 8 weeks ago. You see, on my longer term monthly charts, with just over half the year gone, 2023 is set up to possibly be an annual key reversal, a very rare pattern. Thus, if we were to close on New Year's Eve, either above 471 or under 399.10, well, then we'd be on. Anything in between and we'd have a lesser outside year. Right now we are looking at a possible outside year, but we still have so many months still to go. Chicago soybean oil. The key pattern here, which I highlighted a good while ago, is the late November 2022 to early June 2023 descending wedge pattern. This is easily seen as it is highlighted in purple on my daily chart. It was not a perfect pattern. You'd hardly expect it to be after over 6 months of continuously watching the market try and thread in between the two trend lines. However, 7 weeks ago, the market broke higher out of this pattern. So for such a confirmed break higher, back then I had previously highlighted a primary target X in the 67.5 area with a secondary harder to reach target X1 for such a pattern in the 78.20 area. This past Monday, prices reached the primary target and drove higher through the July 2008 high at 68.13, but were halted and retraced back by the June 2008 high at 69.12, though not by that much. Now, I've taken the opportunity this week to draw a bullish shift pitchfork for the action from the last day of May to the latter part of June. You can see this pitchfork highlighted in bright red on my daily chart, and it seems to be a reasonable pattern, with the market currently in between the lower tie and below, currently at 64.16, the middle tie and above, currently 68.61, and I would suggest paying special attention to the tines of this pitchfork going forward. Now, one final thing, and something I mentioned 4 weeks ago and ever since. It was this, and I quote, "I would consider this descending wedge pattern may, just may, have lately morphed into a possible scallop pattern." End of quote. Now, I am not going to expand on this area any further at this time, but I wish you and also me to keep this in mind for the future.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.